When something actually started to come down in 2000 and end of 2006, 2007, people described it as a gully. It's a gully. This is a little gully here. Real estate values always go up. And I was 23. I had read about how the 5 profit centers paid me in rental property investing. I was not an expert in home price appreciation. There were very few experts in home price appreciation, as evidenced by the entire country, almost everybody being wrong about how home values don't always go up. But for me, I just assumed values were going to go up. I remember looking at those pro formas in the beginning when I would buy those rental properties, and I would say, well, geez, I'm going to get 4 or 5 or 6% appreciation year over year. So I was just like everybody else. I assumed that the value that I was buying at that time, the price, was lower than what it would be the next year. But for me, it didn't matter. Like, the home prices didn't matter as much as it mattered to other people, because I was buying for all 5 profit centers.
Hit me with the 5 profit centers real quick.
Net rental income, which is positive cash flow. That's what was going to keep these assets paying for themselves every single month. We've got tax savings, right? These incredible tax advantages that we get for this asset class. We got principal pay down. So my residents paying my loans down for me. It's really attractive. Then we've got home price appreciation, which we now understand how home price appreciation works, and we can talk a little bit more about that. But at that point, I just thought home values went up like everybody else in 2006. And then number 5, inflation hedging. Now, honestly, I probably didn't understand inflation hedging back in the day.
I had 2 questions. Did you understand inflation hedging when you were 23?
I didn't understand it when I was 23, to be quite honest.
And was gully a popular term of kids your age at that time?
I don't know. I don't know. Maybe.
All right. Continue.
Probably. I wasn't the coolest kid at 23 anyway, so I use terms like gully. Yeah. So, in fact, I was just watching the movie called The Big Short, which actually, I think is a really fantastic movie. It chronicles a lot of the housing collapse and all of the reasons behind that. But I remember at one part in the movie, they were talking to a real estate agent in 2006 who was trying to sell a piece of property. And they said, "Oh, do you think values are going to go down? They just went down last month." She goes, "Oh, it's just a gully. It's just a gully." So apparently it was a term back in the day. Lest I digress. So I just was so fired up about this in 2006. I thought things were going to continue to go up just like everybody else. But the key difference for me is that I had learned enough. I had been around people who had been successful in rental properties enough that the big differentiator for me was that I was buying properties that paid for themselves every single month. Whereas the rest of the country was also thinking that home values were going to go up, but they were buying $400,000 houses, hoping to sell those for $500,000 6 months later. And the payment on that $400,000 house that they were buying was much less than the rental income that could come in. So I remember at that time, people would say, "Oh, you're in real estate? What kind of houses are you buying?" And I would say, "Well, I'm buying below middle income housing and it's positive cash flow." And they would be like, "Oh, well, that doesn't look nearly as fun or as exciting." And for me, I just looked at it and I'm like, well, this is cash flow. Like, this is risk mitigation. Like, this is one of the 5 profit centers. The vast majority of other people investing at that time were speculating. They were hoping prices would go up, and that was their only way of making money.
Okay, got it. You said right now, you mentioned very much rental property portfolio. Was that the key driver to start rental property portfolio, or were you like real estate and rental property portfolio is one piece of this?
Well, in the beginning, I was just coming from a job that I didn't enjoy, and I knew I needed to be able to stand this company on its own 2 feet very quickly. So coming out of the gates, I was more excited about flipping houses because I needed to generate enough income to pay my bills every single month. And I also wanted to prove to myself that I could do this business and actually buy a house and then sell it later. So the real estate active business of JWB was doing any and all things, flipping, wholesaling, flipping high-end home, lower-end homes. And we did that in the absolute very beginning. We're really excited about it. Soon thereafter, once we sort of proved that to ourselves, it very much went to, all right, how do we start to build our own rental property portfolio? And so that's why from 2006 to 2008, we bought 32 rental properties for us to hold on to. And that was in addition to hundreds of other properties that we had flipped in one way, shape, or form. I have borrowed high interest debt with a balloon payment. And, if you don't have a bank on the back end to refinance out, well, you got a problem. Yep. And so as we all know what happened in 2008, the great financial crisis of 2008, if you weren't in real estate at that time, what you might not realize is that overnight lending ceased. Between everything that was happening in Wall Street, overnight, people who were supposed to get loans that were going to close tomorrow instantly were just given rejection letters, and those loans that you were going to close, either refinancing or purchasing or whatever, just wasn't possible. And if it wasn't possible for normal everyday people, it definitely wasn't possible for real estate investors, and definitely not for real estate investors who started their company within the last 2 years and who were 23, 24 years old. Like, it was like hard pass, which we didn't understand the risk of this strategy at that point. This strategy that I just shared with you is called the BRRRR method. Buy, rehab, rent, refinance, repeat. That's what you may hear of the BRRRR method. We were doing the BRRRR method before they even put a BRRRR acronym together. That's how we did it.
Before it got cold.
Before it got cold. It was still hot when I was doing the BRRRR method. So we didn't really understand the risks that go along with the BRRRR method, but we understood them real quick when we got 10 denial letters for the loans that we were refinancing at that point. Because once we did this one time, instead of just having one lender that I was doing this with, well, I realized that this was going to work. And I said, I went and raised money from 10 other people. And now we had, call it $750,000 in loans, which were going to be due within a year that we were paying 10% interest on. And, if you don't have a back-end lender there, you've got a big payment to make. And so this was a big deal for JWB. This was a moment of great stress. It was an inflection point for our business. I remember when we got those denial letters, and it was Adam Riegel and I, and we sat down, and like up to this point, we had never really sold anything. We didn't sell rental properties at that point. We were really good at renting them out and doing the property management. We were starting to become really good at it, but we had never packaged this to sell. So selling this rental property was not really an option for us. Refinancing was no longer an option. And we looked at ourselves and we said, oh my goodness, we have to figure out, how to get out of this situation. How are we going to do this? And nobody knew how to sell anything. We didn't know how to market anything. We didn't know how to sell anything. So those were some really tough moments for us. We just didn't know what to do.
So now we're at 2010. You've decided to go all in. You're going to start also selling people rental properties because that's the lifeline to your business.
Right.
Knowing that the key to this thing is maintaining quality of life in the short term while it does this thing in the long term. And you were going all in. What was the move?
Well, so 2008 was the commitment to turnkey.
Yeah.
And 2008 and 2009 were, it was a painful time for the business, but we just looked at those as short-term losses, right? That was fine. The big thing for us was like refining and getting better at this experience of helping people buy rental properties. And we tried a whole bunch of things, and some of them worked really well, and some of them we stubbed our toes a little bit and all that. But at every moment we were like, okay, how do we get better and how do we get better? One of the things that we looked at was property management. So if you think about our journey from property management, for the first couple of years, call it 2006 to 2008, we managed all of our own rental properties. And during that time, we got high rent rates. We got high renewals, right? We even started to get long-term leases being signed. And once we got to about 40 rental properties, call it around 2008, we said to ourselves, listen, we've got a sizable portfolio here. Managing properties is not the best use of our time. It is not what we wanted to do, right? Again, 2008, we didn't really know we were going to become this turnkey company, right? We did what a lot of investors do. And we said, well, let's go and let's find a property manager and let's have them manage our own rental properties. And we had 40 properties. And so we interviewed a bunch. We found the best that we could find. And from that point forward, we were really disappointed in the property management team that we hired. And this was a portfolio of rental properties that we had managed for 2 years. So we knew the resident relationships. We knew that people should be renewing and we should be getting rent increases and long-term leases and long-term resident stays. And as soon as we put our properties with another property management company, guess what happened?
Not as high a renewal rate, not long-term leases.
Yeah.
High turnover.
High turnover, not getting rent increases, And we just couldn't figure it out. And we got every excuse under the sun. oh, the resident just had to move or whatever, and they didn't want to sign a 2-year lease anymore. We had like 10 straight 1-year leases that were signed. We're like, how is that possible for people to only sign 1-year leases, that many, after we had signed so many 2-year leases, couldn't get rent increases, things of that nature. And we just said, this is not right. And we got really frustrated with it. And at this moment, we were starting to gain some traction. We were starting to make some turnkey sales, right? 2008, 2009 is kind of where I'm going now. And during that time, we would refer people to a property management company. We would refer people to the same property management company that had our rentals. And it became very clear over that year that that was not the best thing for ourselves, for our rental property portfolio. And once we realized that was not the best thing for our clients. And beyond that, again, we've always had this long-term game, right? Again, we were 25, 26 at this point. So we knew we were going to be here for a very long time. And we said, if we really believe that this business model is going to work and is going to be sustainable, and that this was going to be our hedgehog, then the single greatest part of that process has to be property management. And we came to the conclusion that nobody else was going to manage properties like ourselves. And we said, even though it wasn't something that we wanted to do early on, we were like every other deal maker out there in the beginning. We didn't necessarily want to do the property management. We looked at the business opportunity and we said, nobody else is going to do it to this standard. We're not going to have better returns on investment for our clients. We're not going to overperform like we expect to do. So that will have them come back, buy more properties for us. And we said, listen, guys, if we're going to try to sell 50 houses a year or 100 houses a year, which is what our intentions were at that point, we have to take property management in-house. We have to love property management. We have to look at this as an opportunity to control the entire investment for our clients. And we just felt like there was no other option.
Got it.
I'll tell you the difference between 2010, which is when we officially started JWB Property Management in 2010, versus when we, my business partners, and the employees that we had at that time were managing JWB's own rental property portfolio from 2006 to 2008. 2010 is when we, more or less, that's when we started to really focus on attracting high-level talent internally.
Okay. That's
when you look at some of the teammates that are leading our organization today. Some of those teammates, Jamie Crawford, Lauren Traxler, right? Adam Eisman, our CEO, he joined our team in 2010.
Yeah.
So we realized that our ability to do property management and to do it well at scale, and for us to sell and provide this experience at scale, we needed to have the best talent that we could get on the bus. And it's really funny. We joke about it now. And if you talk to Lauren, who runs our client service team, or if you talk to Adam or Jamie or any of the veterans here who've been a part of JWB for so long, like the recruiting pitch to join JWB in 2010 was not very attractive. I'll tell you, compensation wasn't great then. It's not like we had this thriving business at that point. We found great people who took a tremendous risk themselves to follow and believe in what we believe and join the mission here. And we're forever grateful.
Why do you think they took that risk?
I think people are attracted to the idea of being a part of something that's greater than themselves, and to do it with people that you just thoroughly enjoy surrounding yourself with, that challenge you. And we always had that component. Those two components are things that we always had. We didn't have much else, but I bet it was that.